What were you doing 10 years ago at the bottom of the financial crisis? In our first program of the year, we typically take a look at the economy and the markets. Today, we will hear from Jack Ablin, Chief Investment Officer at Cresset Capital. Jack is the leader of Cresset's investment strategy and provides investment policy and philosophy guidelines to the firm's advisor teams and its clients. In addition to 3 decades of experience in money management, Jack is the author of Reading Minds and Markets, Minimizing Risk and Maximizing Returns in a Volatile Global Marketplace. This was published in July 2009. Jack is a frequent contributor to media companies including CNBC, Bloomberg, The Wall Street Journal, and Barron's. In his role as an educator, Jack was also a professor of finance at Boston University's Graduate School of Management. And Jack is returning to Seattle for the 3rd time. Please give him a warm welcome.
Thank you. Thank you, Kim. Thank you, Ken. Hope you all can hear me. Anyway, it is an honor to be invited to the Seattle Rotary, but it is a particular honor to be invited back. So that's, I'm going to wear that as a badge of honor today. And speaking of honor, of course, your Seattle Seahawks are doing great. I come to you from South Florida, came in yesterday. And with any luck, you will be visiting me in South Florida in the first weekend of February. Thank you. So, anyway, what I want to do is really take you through an interesting way of looking at investing. We certainly, I think, will have time for Q&A to talk about markets this year and next. But what I want to do is reframe the issue. So I started my career in 1982. In fact, I think I'm probably one of the oldest consistent Bloomberg subscribers, back before it was actually called a Bloomberg. It was called a Merrill Lynch Market Master. But what I found was it was an interesting combination of things. One is I have a mathematical background. I was a mortgage-backed securities trader, so I was able to try to figure out the option embedded into people either refinancing or prepaying their mortgage. But it was also the time when all of the employers started to move from a defined benefit program to a 401k. And it was critically important for your generation, right? Prior to your generation, as a lifelong employee of a business, your retirement needs after you worked, your lifestyle was taken care of. It was locked in as a defined benefit. Realizing that's a hard thing to do, employees started dumping that responsibility onto their employees. And now we have a whole generation of Americans who are fending for themselves. And so one of the things I find as a math student, but also a student of human nature, is this whole dilemma between wanting predictability and tranquility in our lifestyles, and yet having it funded by something as irrational, unpredictable, and as volatile as the financial markets. And what we find is, not surprising, if you're looking at your nest egg bobbing up and down and you're trying to maintain your lifestyle, obviously raising your lifestyle is nice, but having to go back to your family and say, you know, all those vacations and things we did last year, we're not going to be able to do this year, that we find that risk is not a bell-shaped curve, right? Upside risk is fine, downside risk is verboten, and we have to figure out a way to manage that lifestyle. And what we find is that this fear of losing our lifestyle creates or prompts us to make irrational decisions, right? We saw the market drop 600 points overnight with this tension with Iran. Happy to talk about markets in the Q&A section. I spend my whole life doing that, but I want to lay out this process for you to consider. And what we see here is on the left chart, in the yellow, investor attitudes. Bullish investors, wildly bullish investors, have exceedingly high expectations. And in a world where the market is a reflection of reality and expectations, the opportunity for disappointment is extremely high. Likewise, bearish investors back in 2008 and 2009 had extremely low expectations. If you're expecting the end of the world, anything short of that is a positive surprise. And so what we find is that mathematically, that if you watch the market a year after we have extreme bullishness, the market tends to be about half as good as when we have extreme bearishness. In fact, it's a factor of about 13% on average when we have extreme bearishness 1 year later versus about 6 to 6.5 when we have extreme bullishness. So if you look at annualized investor returns over the last 20 years, you'll find that the average investor has underperformed not just the market, they've underperformed inflation, they've underperformed the cost of living for 20 years, largely because of poor asset allocation decisions, selling at the bottom, maybe buying in with high enthusiasm at the top, and really truncating off and really curtailing their opportunity in the marketplace. And so what I want to try to offer to you is a process very similar to what employers used to build their defined benefit program for you to employ for your own portfolio and your own lifestyle. And the way we do it is, it's called goals-based investing, but essentially, instead of worrying about stocks, bonds, cash, 60-40 mix, and use that pool to fund your lifestyle, we say, what is your lifestyle? How is your lifestyle defined? And everyone's lifestyle is defined by simply a series of cash flows from today for the next 40 years. And once I have that time series, what we can then do is build a portfolio with the fewest number of assets possible that can get us to a 95 or even 100% likelihood of delivering those cash flows. And we do it with and it's an optimization, so we're trying to apply as few assets to that endeavor as possible. Now, once we have that committed, then the vagaries of the market are completely out of the equation. So then these statistics and these models take into consideration the financial crisis, the Asian contagion, the taper tantrum, all of these moves. But what we do is it's really a combination of two things, right? Everyone knows that the one free lunch in investing is diversification, right? Harry Markowitz from the University of Chicago won a Nobel Prize for that work. So this is really just the average return of individuals versus inflation, and you can see how low that is and poor decisions they make. This is that optimization I'm talking about, where as you apply more and more assets, the opportunity of covering your lifestyle improves, and then we try to get to that, you can see it's an asymptotic chart, and we try to get to that apex, that sort of crossover point where we can have a very high probability of achieving those lifestyle cash flows with the fewest number of assets possible. And what that allows us to do is dedicate a portion of the portfolio to generating your lifestyle and then figuring out how much left over to do the things you've just been talking about: impact investing, multi-generational, charitable, high returning, low liquid, long-term investing pursuits. And that's what we're talking about. So the process is, wait, I think there's one step here. Oh, okay, that's right. The process is really three strategies There's an income strategy. So what we want to do is, rather than talk about stocks, bonds, and cash, we're talking about generating cash flows over certain periods of time. So we want to talk about generating cash flows from overnight to 7 years. And we use what's called a lifestyle strategy. We maximize income subject to a 95% success rate in a positive return over any 3-year holding period. The growth strategy is generating cash flows from 7 to 15 years, and its objective is to maximize total return subject to a 90% success rate in making money over a 7-year holding period. And then the aspirational strategy, 15 years and beyond. So rather than to worry about stocks, bonds, and cash and what it's trying to do, what we're looking for is time horizon. And the conclusion here is, do not own 1 ounce of stock unless you have a 7-year time horizon. Because short of that, I'll give you a great example. Let's say you know you have a $100,000 tax bill due April 15th. How many people will buy Apple stock, $100,000 or $95,000 of Apple stock, hoping to pay that April 15th bill, right? I love Apple stock, okay? We have a ton of Apple stock, but I would not recommend 1 ounce of Apple stock for an April 15th time horizon, because the stock market and I will stand here and tell you as a market predictor, the stock market between now and April, or between now and June, or even between now and December is random, okay? I can't stand here with a straight face and tell you what the stock market's going to do. I can give you my biases, but I will find most of the time I'm probably going to be wrong. And so what I realize is, if I hold equities for 7 years or more, my chance for success is much higher. And that's really what we're trying to do. We're trying to use the math of diversification and time horizon to achieve these objectives. And once we have that, then we can do the aspirational. And by the way, we have combinations of public and private. So we will, in our income maximization strategy, sure, we'll use bonds and we'll use preferred stock, REITs, master limited partnerships, but we will also use music royalties, life insurance settlements, litigation finance, and try to generate income from a variety of sources. And so it's a great way to maximize yield that way. Here are the steps. And the steps are, step 1, we want to figure out what the goals are. And I'm not here to judge what your cash flow needs are. I'm not going to tell you what you need to spend for groceries. That's maybe between you and your accountant perhaps. But just give me the cash flow, tell me what it is for the next 40 years, and we can optimize a portfolio that will essentially lock that in. We then build the investment program and then report. What the report looks like is this. Not so pretty, but it shows what our assumptions are. The 90th percentile assumption in yellow, the 10th percentile assumption below, and then the actual, and then you would actually see your portfolio zig and zag, and hopefully in the middle of that envelope chart. And then in conclusion, I just want to explain that risk in many respects, especially when you're drawing money out of the portfolio. Everyone talks about dollar cost averaging. And dollar cost averaging, when you're putting a set amount into your portfolio as you're young, is a fantastic way to invest. The problem is the opposite of that. When you're drawing money out of your portfolio on a periodic basis, what you'll find is that in many respects, the risk, the volatility of your portfolio has much more impact of your outcome than the return itself. So what I'm showing you in the upper left are 2 portfolios, both of about, I think they're $5 million portfolios, and those are the returns of the yellow versus the gray. Both have a return of, what is it showing, 8%, and one has a standard deviation of 7.4, the other has a standard deviation of 19.6. And now what we're doing is we're taking that $5 million and we're drawing $250,000 out of it every year. Now, as I said, everyone focuses on return. The return of both, the annualized return of the yellow and the gray in that first slide on the upper left are the same. But what we find is the outcome's dramatically different. In fact, looks like in year 5, the difference in portfolio of this $5 million portfolio is $2 million, because as you're drawing money out, you're forced to take money out in a down market. And you don't want to have to do that. And so that's why managing the risk of your overall portfolio and try to create predictability through diversification and through time horizon is the best way to manage your retirement and deliver to you a predictable lifestyle and the cash flow that you've laid out. So that kind of concludes my formal remarks. What I want to do now, Ken, how much time do we have? An hour? Love it.
20 minutes.
Okay. I've got about 20 minutes to talk about markets. So let me just kick it off, and then I can share some thoughts on the markets. Happy to address anything on this. But I just wrote a piece on the U.S. equity market this week, actually. And generally, when I look at the U.S. equity market and gauge it over a 12 to 18-month time horizon, there are 5 factors that we evaluate. The valuation, is it expensive or is it cheap? The economic backdrop, if you consider markets are like tropical fish, the economic backdrop is sort of the temperature of the water they're swimming in. Liquidity, the availability of money to borrow, spend, and invest. Psychology, as we talked about, either extremely bullish investors or wildly bearish investors. And then momentum, sort of a market in motion tends to stay in motion unless otherwise acted upon. I think someone said that once. So anyway, that's where we are. The evaluation of the market is expensive. It's not wildly expensive, but it is high. Out of if I were to kind of draw a percentile ranking, it's between the 60th and 80th percentile of its historical range. If you look at the market on a price to earnings, price to sales, and the traditional measures that we look at. The one metric that suggests that the market is cheap is through the lens of the bond market. And that's because interest rates have been brought down artificially low by the central banks through quantitative easing, and then have been held artificially low since that time, making stock investing certainly a better deal than owning a lot of bonds. The economic backdrop, at least in the U.S., is pretty stable. We're growing at potential. Our potential GDP is about 2 to 2.5%. I get that by just looking at 2 things. Growth of our labor force at about 0.7, and productivity growth about 1.5. That's the capacity of our economy. We can certainly grow faster than that. If we lower our corporate tax rate, as we did in 2018, for a couple quarters we can grow over 3. But essentially, we're just beating a 2.5%, 2.2% donkey into a 3.5% racehorse. It's not going to go that much farther without creating some sort of distortion. So the fact that I see the economy growing at 2 to 2.5% for 2020 is a good thing, because we're growing within our kind of our parameters. So we're not going to create too many excesses. Liquidity, that's what's been driving this market. The Fed lowered rates 3 times last year. Lenders are tripping over themselves to put money into the market. The credit spread, which is the yield premium that lenders require to extend credit to lower quality borrowers, is in like the 10 to 15th percentile of its historical range. Very, very low, because investors are starved for yield. That's a great thing, but the problem is, where do we go from here? In many respects, liquidity, we're sitting on the North Pole. Any step we take is going to be a move south. And the market tends to look at trends in liquidity, not necessarily the level of liquidity itself. So that's something I want to pay closer attention to. Investor psychology. How many people here think the market's going to go up in 2020? How many people here think the market's going to go down? Okay. That's about, I would say it's about a 50-50 mix. it's about where investors nowadays are situated. It's sort of in the middle of the range. I think they're in the 60th to 70th percentile of bulls divided by bulls plus bears. It's not a real meaningful number because, as I said, you need, in order for psychology to have an influence over the market, you need an extreme. If everyone here were saying, I think that absolutely the market's going to go down, you know, this Iran thing is going to blow up, we have all these other issues, Elizabeth Warren is going to come in and take my, you know, $50 million of wealth away, that I would say, okay, that's a bullish signal. But we're not there yet. Maybe give it a couple of months, we'll see what happens. And then lastly, momentum. Market is still powerfully to the upside. The path of least resistance is higher. I would say looking out in 2020, upside of the market is going to be matching what earnings growth is. Right now, analysts are expecting 14% earnings growth for 2020. My sense is a better number for that is about 9. I think if we can get 9% out of the stock market, I think we'd all kind of like put it away and move forward. Downside risk, if we do get to a point where we have some concerns and people start looking at valuation, we could see a 15% downside. I would use a 15% pullback as an opportunity to buy. So that pretty much summarizes where you know, we see things on the market. But what I'd like to do now is perhaps open it up for any questions that you have. And the answer to the first question is the Seattle Seahawks.
Yeah. You said earlier in your remarks that one of the goals is a minimum number of assets. Can you explain why that's important?
Sure. A minimum, so you know, if I'm presented with a cash flow and I want to be able to lock it in with 100% certainty, I can certainly do that. If you said, okay, you know, I want, you know, $10,000 a year for the next 10 years, you know, I could take $100,000 and just put it in a money market fund, okay? The problem with that is you're not going to get much return out of it, and it's costing a lot. You take the whole money and put it away. So what I want to try to do is use the markets to our benefit and use time horizon to our benefit so that we don't have to take the 100. Maybe we can lock in that cash flow stream for 60,000 or 70,000, because then we can take the other 20 or 40 or 30,000 and actually move it into much higher returning assets. So assets that are used to generate cash flows are not going to be very high returning. I mean, with the yields so low and upfront cash flows are relying on that predictability, it comes at a cost. Bonds are an expensive luxury in my view. And so what I want to try to do is maximize the outcome with the minimal amount of dedicated assets. And then that frees up other money to do some really powerful stuff.
Question over here.
Yeah.
I noted in your longer term horizon, the 7 to 15 and the 15 and over, that you have private investments, private equity, for example. A number of us have been involved in private equity over the years. One of the things, the risk of it is the lockup period and the time for those assets to actually produce returns. I just got the last return on a private equity fund I invested in 1994. It was a 10-year fund,
yeah.
But then it kept going and going and going, and finally the last thing is.
Yeah, the last little
and this
tail
is something that, at certain age, you don't invest in something that is, you might have a 10-year horizon, but if it's a 10-year lockup, it might actually be 20 or 30 years before you get your money back.
That very valid point, and that's the reason why two things. One is we put private investing in our aspirational strategy, so that's the 15-year and beyond. Recognizing when we buy a building or we buy a company, because we do direct deals, we don't do funds, because we don't like blind pools and we don't like the drawdowns and the J curve and all that. We're doing specific deals. But we have no exit strategy. We're content to hold forever. And if you look at the most successful family businesses in the country, it's really buying and holding individual companies, private companies, or real estate. And so that's the strategy. But we're not using that necessarily to drive lifestyle cash flows. That's going to be for charitable, multi-generational, impact whatever. Now, that said, we are using some private equity. We have a private equity secondaries strategy that we're using in our growth, our 7 to 15-year strategy. There, we're buying, so for example, let's say, after 10 years, you're tired of holding that, stub piece of your private equity. You could have sold that to us. We would have bought that, put it in that fund, and we make markets in private equity secondaries. And that's an interesting strategy. Yes?
Great presentation, Jack. Thanks for being back. Could you talk a little bit about a number 6, which is the reduction of the corporate tax rate, and how you think that might affect us this year?
Sure. Yeah. So, the reduction of the corporate tax rate certainly provided an economic boost last year and early this year. The jury still remains out on whether it will achieve what Republicans suggest, that it'll pay for itself over the next 10 years. My worry is when you start looking at, for example, business capital investment, we're not seeing the capital investment that perhaps the General Accounting Office had projected in their numbers. Some of it could be because of the uncertainty surrounding the trade relationship with China. I don't know. So if we can, if the president can hammer out a plan, even I believe we're going to have permanent tariffs in certain categories. It's just a fact of how this negotiation is going. But once there's clarity and once they say, here's the rule, these are the sets of rules, then I could see perhaps we start to see some capital investment again. And that's the key ingredient. If we can get capital investment, we get productivity up, and guess what? That 2.5% potential can now maybe go to 3 or 3, even higher. We'll see.
Yes, with interest rates as low as they are, it strikes me as a perfect time to have employed leverage in different investment strategies or portfolios. To what extent do you consider and or use leverage within the investing strategies that you employ?
Yeah, it's a great question. We don't so much. In fact, I'm a little bit chicken of leverage because what I'm trying to do is create predictability. So, for example, if we buy, an apartment, let's say we buy an apartment building that we want to rent out. What I want to make sure is that the cash flows that this apartment building is kicking out, or the principal value is kicking out, can sustain itself over time. And I want to be in a position where we can lower the rent and still survive without being forced to sell into a distressed situation or a down market. So in general, we buy a building, I would say the highest leverage we use is 60%, which is low. Certainly our IRRs are going to be lower, but again, what I'm trying to do for our investors is to create as much predictability in an uncertain world as possible. Now, on an individual one-offs, there may be some opportunities, but in general, for our strategy, leverage doesn't work as well because of the unpredictability.
Question over here.
Thank you. My name is Pierce Murphy. I'm the development director for a large nonprofit, and my question is a little bit off the track, but it's your investors. Did the 2018 tax code changes affect their charitable giving at all, and what do you see in the way they're thinking about philanthropy as a result of that?
Sure. No, in fact, I think because of the run-up in the market as a result of the tax benefit, I found that our clients, at least our clients, have been actually more generous with foundations or direct to charities than perhaps a flat market or a down market. So no, I don't. In fact, I'm treasurer of a large foundation, and we've had absolutely no discussion about changing any kind of policies based on the tax code. So I haven't seen it. And foundations are a funny thing. It's designed by the government to hand investment to private individuals, where the government can't make these. Governments can't give to churches. The government can't give to certain things. They can't track all this stuff. And what I found was remarkably, now this was a few years ago, that in general, foundations collectively give about $36 billion away per year. The tax benefit is about $36 billion. It's essentially the government telling individuals, here, you figure it out, you do the homework, and you do it. We're going to hand that responsibility to you because you're going to do a better job than us trying to parcel out where it goes. So I think foundations and private investing are doing, it's a fantastic job, and that's something we can't change. We shouldn't change. Yes?
Hi, Jack. Good to see you, Mike Adams. I think we're speaking at Orlando next month.
Yes, yes.
Anyway,
the week after the Super Bowl.
The question is this. You talk about the U.S. GDP, but isn't it more correct to talk about world GDP? Since the Standard & Poor's 500, those companies have between 50 and 60% of their revenues coming from overseas?
Yeah. Actually, it's what I would look at, rather than GDP, I look at GNP. GNP would measure U.S. companies doing business abroad versus GDP is Toyota doing business here. So that's what I tend to look when I'm doing metrics where I'm trying to use the economy as the denominator of the equation. I look at GNP. But world growth, I think the same thing. I mean, I actually think we're going to see some catch up from our foreign trading partners this year if things, remain stable. I would tend to think that that's, we're going to see some catch up from some of our trading partners, particularly in the emerging world. But I do think the developed world, like European Union and even UK, they're going to start embarking on fiscal stimulus, infrastructure, and I think that's certainly going to benefit. But I'd love to see the central banks start to back away a little bit, just because they're creating distortions that, for example, corporate debt as a percentage of GDP is at an all-time high. And while bulls can stay comfort by saying, well, their coverage ratios are the same, remember when homeowners, would-be homeowners were taking these teaser rates and these, it's sort of the same notion, and I get a little squeamish when I hear those comparisons. Is that it? Anyway, thank you very much for taking the time with us. Again, I appreciate all the invitations. Thank you.